Okay, the last video went through the calculation of the foreign tax credit and its limitation, at least here in the U.S., where it was related to that equation based on the ratio of foreign source income over total income times the total tax. What we're going to do here is build up to an appreciation of the foreign tax credit, and we'll do that by retracing some steps that we did yesterday, which is understanding methodologies for mitigating double taxation. Remember, one of the principles that we learned last night is that we want to have tax systems that limit no, meaning have no double taxation, double tax, and we also want to have tax systems between countries that avoid double. What was the other thing we said? Double what? Double non-taxation, so that income shouldn't escape tax from someplace. That's the goal. So retracing it and now seeing it illustrated. Suppose there was income and between countries or amongst a country that is taxing its citizens, but provides, as it says here, no mechanism for mitigating double taxation. So here, let's say this is the U.S. as an example. Let's call this the U.S. It taxes worldwide income at 30%. So Mr. A, let's call this Mr. A for alien, pays the U.S. tax at 30. But meanwhile, this income was really foreign source. It came from a foreign place, not earned in the United States. And because of what we were talking about last night, jurisdiction, the foreign country has the jurisdiction or the legal ability to tax it, and so it does at 20%. 20% is paid here, and now the total amount of taxes paid is a double tax situation. Number one here, and number two here, total of $50 tax. Different rates, but still double tax. That's what we want to try to avoid. So there's two ways of doing it. It's the traditional territorial system is one way. That's one way to avoid double taxation, and the traditional works like this. The income is sourced as foreign income, so this is the foreign country that the person lives in, and as a result, it gets taxed at the foreign rate of that country for $20, as we see. But here in the traditional territorial system, the territory home country doesn't even tax it at all. It's exempt. That's what we meant by exempting the income. Now, that's the traditional territorial system, the traditional. We also spoke about what we call hybrid, where its citizens pay tax on worldwide income while they're there, like the U.S., but they don't continue to pay worldwide income when they're not living there. That's the difference between a hybrid and a system and the U.S. So in a hybrid system, you would need, in order to mitigate double taxation, you would need what? You would need to go to the foreign tax credit. Otherwise, instead of being exempt in the hybrid method, it wouldn't be exempt, it would be taxable. So the hybrid method the hybrid method will result in needing to avoid double taxation. You'll have to use the foreign tax credit. That's why I called this originally the traditional territorial system. All right, let's take a look at how the credit system, the foreign tax credit system, that's what it means here, how this mitigates double taxation. Again, we'll start with the fact that $100 is made overseas in a foreign country. It's taxed because it's made there at $20. That's the rate. That's the tax rate of the home country. Okay, no problem. Meanwhile, back to let's again use the U.S. as the example here, taxing on all income at its rate, but now with a credit for the foreign tax paid, the net result of tax paid in the U.S. in this example is only $10. This avoids double taxation. However, look at what actually happens. Tax is paid at what rate on this $100? Remember, the $100 is foreign source. That's here. And the amount of tax paid is $10 here plus $20 here, 30. So the tax is paid under a credit system at the highest percentage rate between the two countries. The highest percentage rate between the two countries. This is one example where, because the credit is limited, and how is the credit limited? To the fraction of foreign income to total income, and in this case that ratio is 1. So the total amount of tax paid in the U.S. is 30, where that's the total tax liability. So in this case, the total foreign tax credit could have been $30, but the only amount of tax actually paid, and this is a good example, the only amount of tax actually paid, the only real foreign tax paid, is the 20. So the credit, that's another way to say there's another limitation. You can't take more credit than was actually paid in another country. That's almost a no-brainer and doesn't need to be said, but for just clarification purposes, even though the credit limitation gave you 30 as your limit, you can only take as the credit what you actually paid in the other country. Okay, moving right along. This is another example of the territorial system. In this case, it's a slightly different setup. Here, the rate, if this is the U.S., the rate in the U.S. is 30% as before, but here in the foreign country, instead of the rate being 20%, now the rate is 40%. So again, in the traditional territorial system, the income is exempt since it's foreign source. It comes from a foreign source. And the tax paid is the tax paid in the foreign country. End of story. With the exemption, we do not have any double taxation issue. Over here with the credit system, in the same situation, same facts, where there's a 40% rate here versus a 30% rate in the home country. Again, we use the U.S. since we know it to be a worldwide income tax system and a credit system to avoid double taxation. Let's see what happens here. Here, the foreign tax is $40, whereas over here in the U.S., the tax rate at 30% in this example, it's not really, but just an example, yields a tax of $30, and the credit is, as we know, the limit. Let's use the limit again. $100 is the foreign income. This is the fraction. Total income is 100 times $30 tax liability equals the fact that our foreign tax credit limit will now be $30, or the total amount of tax actually being paid in the example. And so the amount of the credit is limited to this amount. Result, we get 0 here, but still down here, $40 was paid to the foreign country. So again, this is an illustration that even in the foreign tax credit system, tax will be paid at the highest rate between the two countries on that income, on that foreign income. All right, now we're going to see an example of further limitations that cause issues when it comes to the foreign tax credit. Here we are saying this is a U.S. tax company. It has total income, $300, which is composed of $100 from a foreign source because it's taxing all income, and it must be that somewhere else there's $200 of U.S. source income. The total tax on all of its worldwide income, as you can see, is $105. Over in the foreign country, down here, on $100 of foreign source income, $45 is paid. And so this $45 will be the object of applying the credit, the foreign tax credit, to avoid double taxation. However, now we've got to look at the formula for the foreign tax credit limit back to the U.S. And how is that going to work? So let's see what the formula is. $100 is the foreign source income over the total income, which is $300. Again, here's the foreign source income here, and here's the total income here. That fraction is multiplied by the total amount of tax at the U.S. level, or 105. And I'm going to do the math in my head, because the problem basically indicates what it's going to turn out to be. This is really 1/3. The fraction here is really 1/3. So 1/3 of 105, this turns out to be rounded $35. That's the foreign tax credit limit. And as a result, what happens is you still wind up, when the initial $100 of foreign income, paying at a rate of 45%, the highest rate between the two. Here in the United States example, it was 35, here it was 45. So the rate on the $100 of foreign source income is still going to be at the highest rate. Here in the U.S., in this example, with the foreign tax credit being at 35, there essentially is no tax in the U.S. I'm sorry, that's correct, but I'm going to redo the way I wrote that. So let's do this. Essentially, there's no tax in the U.S. on the foreign income in the example. So we've successfully avoided double taxation, but nevertheless, the tax will be at the highest rate between the two countries. If there were no limitation, that would be great. Same example. Now let's say there's no limitation. Whatever foreign tax you paid somewhere else, you get a full credit for it here. That would be fantastic. That would result in bringing down the tax on the foreign income to the lowest rate between the two companies. And in this case, in this illustration, it would be the 35% rate over here. But that's not the way foreign tax credit limitation works in the United States, and most countries follow the U.S. example. Most countries that are using the credit limit to avoid double taxation. Okay, that's it. Hopefully that helps further understand the differences between the source of the income, the use of the foreign tax credit as one means to avoid double taxation, and the traditional territorial method, which is basically an exemption of foreign income to avoid the double taxation.